At this point, I would like to introduce our first speaker, which is Lawrence Gray. He is the Chief Executive Officer of GrayCo. You have his biography, but I got to tell you, it's a fascinating story of how multi-generational firm has dealt with major holdings of real estate. They've been very active with it. They've had timberland holdings. They've sold. They've bought. They've gone into apartments. Lawrence actually started his career off in New York, Morgan Stanley, Wachovia, in asset management, investments. And 3 years ago, you came back to Richmond to head up the family firm. They're having to make real decisions in a confusing market. And so this will be our first speaker. Lawrence, come on up.
Thanks, Sidney. Okay. All right. Can I be heard? Excellent. Excellent. Well, thank you, Sidney. And just to clarify, I actually have been back in Richmond for almost 15 years. I spent the first 17 years of what I call my white-collar working career in the investment banking business. And then 3.5 years ago, went over to be the CEO at GrayCo. And I'm going to speak today about the history of our company and really the evolution that we've gone through over the course of the last 30 to 40 years. And at the outset, because I've got several family members in the audience, I want to make sure that everyone understands when I use the term we, I mean them and not me, because I was not around 30, 40 years ago involved in the business. I've been on the board for 15, and as Sidney said, in the CEO role for the last 3. But there are several members that are around this audience today. I would encourage you to talk to them that are members of the family that were really the ones involved in some of the major and important decisions that were made along the way. Today, I'll just use this slide as sort of the snapshot of where we sit today. GrayCo is a private commercial real estate company primarily focused on the high-end apartment sector in the southeast. We own about 5,100 apartment units from Norfolk over to Nashville, Houston to Central Florida in that region of the country. We do continue to own some interest in timberland throughout the Tidewater and Chesterfield County, and we own some large land positions of zoned but unimproved land. The three most notable being some land down at Lake Chesden, the Tree Hill Farm just east of town, and the village at Westchester right at 288 and 60. And in terms of our portfolio, this map sort of gives you an idea of where we have our properties, and you can see the apartment properties are quite spread out, whereas our land investments are very close to the headquarters, which is testament to the fact that we were a lumber company for many years prior to getting into the commercial real estate business, and that was a much more local business. Mark and Bill were nice enough to ask me to join the speaker group here, which was very nice, and they really didn't want to spend a lot of time talking about what we're doing today, but really talk about how our company has evolved, recognizing that a lot of you are in a position that our family may have been in 30, 40, 50, 60 years ago, and many of you may be encountering some of the issues that we were encountering along the way, and might be able to glean something from the comments here. I'd say that we're a fifth-generation family business, so we've been around for about 125 years. The first 100 of those years, we were in the lumber business. We had timberland in the Tidewater area. We had a mill in Waverly, and sort of operated that business over the course of a very long time, quite successfully, through many of the sort of first 3 generations of the family. But in the late 80s and early 90s, several of the senior members of the family identified several factors and issues that were coming at us that really needed to be addressed. The first of those would be the fundamentals of the lumber business were evolving in such a way that made the Gray Lumber Company, which was a mid-sized operator, less competitively well-positioned compared to the smaller, more nimble operators and the larger, more diversified companies. Secondly, we had a fair amount of concentration risk, as I'm sure those of you that are in the real estate business can understand. But we had concentration risk in terms of our type of asset. We were primarily in essentially pine trees in the Tidewater area of Virginia. We had a mill in Waverly. And that concentration risk was becoming even riskier as a result of what was going on in terms of environmental consciousness and what that meant for large landowners like us that were in the business that we were in, and sort of evolving attitudes among governmental organizations and the general population in the areas in which we operated as it related to large landowners and our rights and obligations around the land use for the property that we own. Finally, like many multi-generational families, the number of folks in your family, it doesn't grow linearly with each generation, but it grows logarithmically. So you got many more mouths at the trough, so to speak, from one generation to the next. And we were in a position where we were asset rich but cash poor, and with a growing number of folks that were looking for some additional current return off of our family business, it was going to be more and more difficult with the asset base that we were managing. So the convergence of all this was going on kind of in the late 80s and early 90s, and my father, together with Elman Gray and Wally Stettinius and Elman and Elman's boys, made a decision that was obviously one of the big transformative decisions for the family, and that was to diversify and essentially exit the lumber business by selling our mill and using the 1031 cash deferred exchange as a mechanism to get out of timberland on a tax deferred basis and convert into commercial real estate and thereby forego realizing a big tax hit at the time that we were going into the business. We did hold on to several tracts at the time that we did our series of exchanges in 92 and 93. Some of that was land that was identified for future development. Some was land that we said we just like having some timberland and farmland investment exposure, and some was environmentally tainted because, as I mentioned earlier, some of the challenges, if you've got, as we learned, if you've got a red cockaded woodpecker in your timberland, you got a little bit of a problem. So you might be owning that timberland for a little longer than you thought, and hence we still own some pieces of timberland that are the home to a nice endangered species. Importantly, as part of that diversification process, we went out and hired a team of experts. Having been in the lumber business for 100 years, we did not have the in-house expertise around commercial real estate. So we went out and hired a team of commercial real estate professionals to come in and assist us with identifying the right kinds of properties in the right locations, help us acquire those assets, set up an asset management platform to go about managing that portfolio, and we set up a management and governance model wherein the governance was the board of directors, that was the family oversight group, and the management team had no family members on it, so there was a fairly clear delineation of family and non-family responsibility and I'd say constructive oversight and constructive pressure to perform on the investment side. yeah, as we undertook this diversification process, there were a variety of things occurring. If you guys that have been around for a while can put yourself back into what was going on in 1990, 91, 92, and 93, with the possible exception of the 2009 downturn, it was one of the worst real estate recessions that we've ever had, certainly in our lifetimes. Our timing was actually quite good. The timberland asset class had seen a decline in value, but nowhere near the amount of decline in value that the commercial real estate business had seen. Importantly, the pools of opportunistic investment capital that were later formed in the mid-90s had not yet been formed, so there wasn't a Goldman Sachs Whitehall fund. There wasn't a Blackstone real estate fund yet. So you combine the fact that those pools of capital hadn't been formed yet, there was a legislatively induced forced selling of commercial real estate by the banks. So again, as many of you that have been around for a long time, if you were participating as an investor in those times, it was a pretty target-rich environment for investment opportunities. And fortunately, again, for us, we've done a good job of hiring a great team of professionals to get invested. So we had capital. There were plenty of things to invest in at the time, and we had a good team with which to do it. And because we were doing 1031 exchange transactions, we had limited time frames in which to identify and close transactions. And so our investment strategy at the time was very broad. We were looking at a very wide array of asset types. So we were buying suburban office, retail, industrial, and apartments. And over the course of the last 15 years, we've really refined our strategy to be just an apartment business because we were able to do that on a much more deliberate basis. Once we got invested with our capital, we could be deliberate at selling assets on a one-off basis and exchanging out of the retail and industrial and suburban office assets and into apartments. For us, I get the question a lot, why apartments? For us, the risk-return characteristics of the apartment sector are very, very well suited for the investment objectives of our investor base. We also felt that having a single asset class provided us the ability to get some economies of scale, thereby creating a property management organization that we could bring in-house and therefore have more control over our asset base. And we just felt that having that depth of expertise in a particular asset type would make the most sense for us. So that's sort of the quick history of where we are and how we have evolved into the organization we are today. The big question that I get all the time, and the reason why I'm here today, is people ask, how is it that the Gray family has been able to maintain itself as a family business for 125 years when most family businesses ultimately just can't make that leap from generation to generation and keep it together? I guess I'd make several observations, again, as more of a family member, but more as a business person, looking back on the history of an organization and thinking, what is it that were, what were the critical success factors that have allowed the business to stay together and prosper? And it's very clear in the course of 125 years, particularly the last 30 or 40, several points along the way where family members exhibited some selfless thought leadership and really led the other members of the family down a path that has ultimately benefited all of us. A very important structural decision was made in the 1970s. Our properties at the time were owned by our family members either individually or in small groups. And in the 70s, we created a partnership. And for those of you that have been involved in roll-ups of individual properties into a consolidated ownership structure, you can appreciate that can sometimes be a very difficult and sometimes impossible task, because everybody's moaning and groaning about, well, I think mine's worth a little bit more than that, and my percentage interest ought to be a little bit more. I think as I look back on it, there must have been, as I would say, a very low jerk factor within the family, because we were able to get through this formation transaction and create a consolidated ownership entity that really is a critical part of who we are today. I'd also say that in the late 70s and early 80s, there was a fairly good and accurate identification of how the family's ownership base and their investment objectives and return needs were going to be evolving. That is obviously a critical element in strategic planning as you think about where will the family be, where will your owners be, what will they be looking for out of this investment in the family business over the course of the next 20, 30 years. Obviously, the generation that preceded me did a good job at identifying how that was evolving, and hence made the decision to get into the commercial real estate business. I think another important component, and for those of us that have been in real estate can appreciate, there was a willingness not to stay wedded to a particular asset class or group of assets purely due to emotion. I'd say there was a fairly dispassionate assessment of risk and economics that, while I think there were probably plenty of family members that loved this particular tract or this particular tract or that building or that, we ultimately didn't let that get in the way of doing what was right from an investment standpoint. As I mentioned, we got into the commercial real estate business, and fortunately, my predecessors had a fairly clear and accurate self-assessment of where their strengths existed and where they didn't. And they were willing to go out and hire experts to come in and execute a plan that they, at that point in time, were not really equipped to execute very well. And I think that's benefited all of us tremendously. There's always been and continues to be and will continue to be a strong emphasis on governance. We want to make sure that our owners feel that despite the fact they might not be in the office on a day-to-day basis, that they're being treated fairly, that their management team is being held to task in terms of sticking with the game plans that we've laid out and the risk tolerances that we've got. That was an important component of our strategy when we set up the governance model that we have today. Most importantly, I'd say investment returns to your owners, regardless of whether you're in a family or a public company, feeling that pressure to perform is important. And our team has done a very good job over the course of the last 20 years generating compelling investment returns. So when we go back to our family members and they say, gosh, why am I invested in this illiquid partnership with all these family members? There's nothing like saying, hey, look, here are the returns that you've received over the course of the last 10, 15, 20 years. Here are the returns that you could have gotten in alternative asset classes, and you want to make sure that that stands up well, and to the extent it does, they're going to want to stay invested with you unless they've got just some liquidity need that they can't avoid. A couple of other observations, I'd say, getting back to risk and return. It is important that your owners understand this trade-off between risk and return. One of the things that I've learned over the course of my career, both as a banker and as CEO at GrayCo, is investors sometimes lose track of the risk component. They'll look at an investment opportunity and they'll say, gosh, well, this one's going to be a 20% return, and this one over here is only going to be 10. Well, 20 is not necessarily better than 10. When you think about what the risks that you've got to undertake to get to a 20% return, you realize that, as my guys are going to hate to hear me say this because I say it all the time, the band of outcomes around a 20% return investment is a heck of a lot wider than a 10% investment. And you want to make sure that the risks you're taking are commensurate with the returns that you're going after. So we try to be very clear about what it is we do and what it is we don't do as a management team. We put together our investment plan. We take it to our board of directors. We make sure they're very informed about what it is we're doing and get them to bless the plan. And then we stick with our investment and asset management program to make sure that our risks are not getting outside of the bands of what we've articulated to our board. Finally, I'd say a very important component in all of this, and it goes with any business, and that is having a good communication plan. If you've got investors in your business, you better make sure you're being overly communicative, because there's nothing worse than an uninformed investor when things go wrong. And in our business, there's no question there are going to be bumps in the road. And if you've got investors that don't have a clue what's going on, when you hit those bumps in the road, only bad things can happen. If you're communicating clearly, sharing the good with the bad, then you're given a lot more running room to work through issues than you are if you've been all clammed up as it relates to communicating what's going on within your portfolio. So with that, I'll wrap up my prepared remarks and hand it back over to Sidney. Thank you.
Thank you very much.